move it. I like to move it, move it. I like to move it, move it. You like to move it.
Hello, and welcome back to I Like to Move It, your go-to podcast for decoding the shifts, shocks, and signals of global trade and markets. I'm Mr. R.
And I'm Alice. And today we're diving deep into a topic that's been dominating headlines and boardrooms alike, tariffs, and how they're reshaping trade dynamics, commodity pricing, and business strategy.
And joining us today is someone who's no stranger to this show, Tim Clark. It's always a pleasure having him back. He's been a guest on several of our past episodes, and we're thrilled to welcome him again.
Tim is head of mining research at SBG Securities, a division of Standard Bank Africa's largest bank, and a key player in the mining, manufacturing, and commodities space.
With nearly 20 years of experience covering global diversified mining and commodities markets, Tim brings razor-sharp insights into the world of bulk materials, base metals, energy, and more. Tim, welcome back. Great to have you with us again.
Thanks, it's great to be back. Always a pleasure to join the conversation.
Let's start with where we are today. The world's been on a globalization journey for decades, but that path seems to be getting bumpier lately.
Right, especially since early April, when President Trump made headlines with some major announcements. Curious. Tim, walk us through what's been happening on the tariff front and how the global trade landscape is shifting.
In early April, President Trump declared the 2nd of April Liberation Day and announced sweeping trade tariffs after decades of increased globalization and lower trade friction. The president unveiled a two-tier tariff structure. A baseline 10% tariff applied universally to imports from all countries, with the exception of Canada and Mexico, and additional country-specific reciprocal tariffs based on what the administration deemed unfair trade practices by approximately 60 individual nations. The tariffs would apply to more than 100 trading partners. However, they would not impact products already subject to previous tariff actions, including steel, aluminum, vehicles, and vehicle parts. Energy products and certain minerals not available in the United States were also exempted. Since this announcement, there have been bilateral talks between countries trading blocs in the United States. Countries that have announced reciprocal tariffs, China in particular, have also faced further potential increases. For now, volatility and uncertainty are the key outcomes. For example, on Friday the 23rd of May, President Trump announced that he would implement a 50% tariff on Europe from 1 June, higher than the 20% announced earlier. But by Monday, the 26th of May, he had delayed implementation to 9 July, allowing negotiations. Planning has become very difficult for exporters to the US, and likely also for US importers. Recent activity data has shown that this uncertainty is also resulting in lower trade activity levels.
So with all this in flux, I'm curious, how are commodities reacting? Has this uncertainty started to show up in pricing?
For now, there is limited impact other than the 10% import tariff being paid by US importers and thus ultimately consumers. Also, many primary commodities have been exempted as they form the input cost of domestic US production. Historically, tariffs have been inflationary. For low capital intensity sectors, there is potential for job creation domestically. The improved economics from higher import parity prices has spurred some economic activity. This also applies to idle capacity and to mothballed capacity that can easily be brought into production and where the friction costs of closure is low, assuming a new leadership potentially reverses the tariffs after the next election cycle. The industries where there is a higher capital intensity or closure friction cost of domestic production tend to lag materially, and inflation is the outcome. Ultimately, demand for the commodities does not materially change, other than the impact of lower demand from inflation, which is more cyclical and less structural. The result is a redirection of trade flows, but with higher friction costs. For example, Russia was a major supplier of gas into Europe before the Ukraine war. Europe is now sourcing its requirements from other energy markets, and prices have risen as a result. But the demand remains in place. Trade just redirects at a higher friction cost.
Let's shift gears a bit. Manufacturing seems to be at the heart of this discussion, especially with the rerouting of supply chains and component sourcing. What's your take on what's happening in that space?
This is where it really gets a lot more complex and the waters become more muddy. Since 2016, when President Trump introduced his tariff agenda against China, there has been a material redirection of Chinese exports to intermediate markets. Thus, Chinese components are being used by manufacturers in Mexico, for example. This is potentially a contributing factor in the broader tariff net this time round.
The concept of fair trade is often cited when tariffs are introduced, but there's clearly a difference in how countries define fairness. Could you shed some light on that?
One of the primary issues is the import of services from the United States, for example, from technology. Europe had a $161 billion trade deficit with the US last year, but Europe argues that its purchase of US services all but overcomes the deficit. For now, this seems to be off the table in negotiations. Trade is about value transfer, and services are definitely of value and hence should be included.
And looking at the bigger picture, many are asking, are we seeing the unraveling of globalization as we know it?
There is no doubt that trade blocs are forming, and with increased geopolitical risks, stronger alliances are resulting. One thinks of Russia, China, India, post the Ukraine war. The world's economy is, however, more integrated than ever before. Most complex products have sourcing from many OEMs and countries of manufacture to maximize efficiency. It seems very hard to see this integration breaking down, and if US consumers face high inflation and weaker economic conditions as a result of these tariffs, it is more than possible that these measures will be reversed as politicians seek out low-hanging fruit in future elections.
Let's end with a bit of forward-looking guidance. Given everything we've discussed, how should companies be thinking about tariffs over the next 3 to 6 months?
We live in a world where the future is more uncertain for manufacturers than ever before. I think that a 10% baseline tariff is likely to be implemented and to stick, and the deals will be done around the periphery for the US benefit, like critical mineral sourcing. It is also likely that in the few cases of US excess capacity or lower capital intensity manufacturing, that there will be a domestic response. In all likelihood, it seems that inflation will tick up as a result, and that economic activity will be more muted over the next 3 to 6 months, a time to batten down the hatches and follow a more cautious and defensive path.
All right, time to wrap up. Tariffs are back in focus, shaking up trade flows, adding uncertainty, and nudging up inflation, though the core demand for commodities remains steady.
Manufacturing is adapting, supply chains are shifting, and questions around fairness, especially on services, are complicating negotiations.
Globalization isn't dead, but it's definitely evolving. For now, caution is key.
Absolutely. Thank you so much for joining us, Tim. We really appreciated your time and expertise.
Pleasure was mine. Thanks again for having me.
And to our listeners, thanks for tuning in to I Like to Move It. If you found this conversation valuable, share it, rate us, and subscribe for more deep dives on the world of global markets.
Until next time, stay informed, stay strategic, and stay connected.
Take care and keep being awesome.
I like to move it. I like to move it. I like to